That's more like 7%. That can't exist forever,
And
right?
there was,
You
and
can't have,
we saw that spike at the beginning of the COVID
yeah,
bump, let's call it, but it seemed
yeah.
like they had come back down and they're both kind of
It
in this
it
long-term
had, but
trend line, but it seems like it's moving again where this
it's
separation's being created.
it's kind of stuck. Let me illustrate that with seasonally adjusted versions of the Board of Realtors data. It's exactly what you say. Right at the moment of the pandemic, single family home prices launched, but they overshot. They went, you know, they went too high and they came back down a little bit, but they didn't come all the way back to trend. They're stuck almost on a parallel trend.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill, Principal Broker Owner at Luxury Homes International, and with me today, Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, it's great to see you again.
Aloha, brother.
All right. Hey, we've got a lot to cover. Interest rates spike above 7%. There are whispers of a potential Fed rate hike. Home sales are up, condo sales are down. Really interesting information in the number of
Mhm.
properties for sale, especially condos. But let's start with pricing. And I'm going to pull this up. This is the latest data from the Honolulu Board of Realtors. And we're going to
Mhm.
start off with year-to-date median pricing. Want to get your take on this. So here we are, median prices is year to date, so first quarter of this
Mhm.
year. And we can see home prices compared to last quarter, up 4.4, compared to 2022, down slightly. And here's where it starts to get interesting. Compared to 2019, where median priced home was 780,000, home prices
Yeah.
are up 37%. And hold your comment because I want to just get into the condo as well. So condo median price in at 505 this quarter. That's up 1% and down 1%, basically flat over the last 2 years. And then
Mhm.
here's the part I kind of wanted to focus in on. Condos are up only 22.8% compared to 2019. Are we seeing another separation of these two? Is that what's happening?
There has been a post-pandemic separation. We think that most of it's attributable to the sudden shift, like an L-shaped, adjustment from working in traditional workplaces to maybe a quarter of Hawaii's population now working in remote settings, uh, typically at home. About 1/8 of Hawaii workers working full-time remotely, and another 1/8 working in hybrid arrangements where they're in the workplace sometimes. So there was a shift in demand towards homes that were farther away from the urban core workplace
Yes.
aggregations or agglomerations. And even, you can work in Honolulu and live on the neighbor islands. You can, right? People were moving around for a while. That tended to favor detached single family dwellings relative to condos. It's not that condos aren't attractive. And 22.8% appreciation over 5 years. Let's call that, 20 divided by 5 is 4% per year with compounding,
Hmm.
and 35% appreciation for single family homes over 5 years. That's more divided by 5. That's more like 7%. That can't exist forever,
And
right?
there was,
You
and
can't have,
we saw that spike at the beginning of the COVID
yeah,
bump, let's call it, but it seemed
yeah.
like they had come back down and they're both kind of
It
in this
it
long-term
had, but
trend line, but it seems like it's moving again where this
it's
separation's being created.
it's kind of stuck. Let me illustrate that with seasonally adjusted versions of the Board of Realtors data. It's exactly what you say. Right at the moment of the pandemic, single family home prices launched, but they overshot. They went, you know, they went too high and they came back down a little bit, but they didn't come all the way back to trend. They're stuck almost on a parallel trend. So what I'm thinking is happening is that, and condos are staying on trend. What I'm thinking is going on is, the true trend is about 4% per annum. And both single family homes and condos were about, roughly on the same trend all through the last decade. When the pandemic came, the the single family home prices punched out as people sorted, it's a musical chairs version. It's a music homes version of musical chairs, right? Everybody busted a move. They found the new place they want to live, the people who could, or the people who were able to. And then instead of settling back to the old trend, it's persisted at higher. So it looks like 7%, but it's actually the overshoot, and we're going to stay at 4%. I mean, that's
Yeah.
theory. That's what I'm thinking.
Yeah, and we're going to see in the other data when we take a look at it, there's a big difference right now in the availability of condos versus homes. We'll take a look at that in a moment. Let's shift
Yeah.
gears for a second and talk economy, inflation, and rates. Despite 11 rate hikes and the hawkish sentiment from the Fed, it feels like inflation's still sticking around. It's not really moving. And from the news we hear, it seems like the economy is reaccelerating across the country. What's going on here?
Technically, the economy did reaccelerate last year. And what was so reassuring was that say GDP growth, for example, was really strong in the second half of last year. It's actually settled back a little bit. Unemployment remains stable. 97% of workers in Hawaii who want a job have a job, right? There's a 3% unemployment rate, which means that 97% of people who want to work have a job. And that the problem more recently is that even though the US has settled into what's probably a sustainable economic growth trajectory, same for Hawaii, actually, after some trouble getting, off the ground post-pandemic, the inflation numbers, which had also settled at the end of last year, punched out this winter. And we're kind of trying to figure out whether we should believe it. And obviously, some people are losing their minds in the stock market, and sort of the inflation naysayers who, kind of had to eat crow last fall are saying, "See, I told you so." And we're just in another moment of uncertainty that will have to resolve itself over the next several months.
Yeah, I mean, even Jamie Dimon, who for the last 4 years has been calling for the hurricane, the Great Recession. I saw him interviewed recently, and he said, "No, there's no recession. It's not coming."
Well,
Um,
those guys were
except
a
for
little too
except for a geopolitical event, of course, or something like that. But
sure,
even
and
he's
that's
kind of
always
pulled back
true.
a little bit. That's even true. So, what about the? It seems, certainly in the short term, there's going to be no Fed cut. What is your opinion about a potential hike from the
Well,
Fed funds?
the sense of things a month or two ago was that a lot of confidence actually in the proposition that the Fed would actually fulfill um, its own signaling that the overnight Fed funds rate, which you see here, this dashed line, these are all the interest rates on the U.S. Treasury yield curve. The blue line is the overnight rate. That the overnight rate could begin coming down during slightly this year. So, it's 5.5% now. Maybe the range is 5.25 to 5.5%. Maybe to 5 and 5.25, and then next year, 2025, we see it come down a full percentage point, 100 basis points instead of 25 to 50 basis points, and that would all commence this summer. Um, this is the Fed's forecast from last month. This is what they published from last month. But you can see there was a difference of opinion, a range with some people thinking that rates might have to go up rather than down, and other people thinking that rates were more likely to come down. But those shall we say less optimistic voices on the Federal Reserve's open market committee, these are the forecasts of the actual people who meet in determination of this overnight rate. Those guys were thinking this is going to take years to get to lower rates. Either way, the overall expectation, and one shared in the financial markets, was that this could start by this summer. And if that was true, it would enable the other rates to come down. Why is that important? Because when the mortgage rate comes down, and here I've inverted the mortgage rate on the right scale, so the dashed line is the mortgage rate, down is up. So if the mortgage rate goes from, let's say, 8% to 7%, you actually see a little boost in sales, as we did coming out of last year into the early part of this year. But more recently, that mortgage rate has backtracked, has gone back to 7, and we've already seen in the March numbers sales volumes starting to slip. The problem seems to be that renewed concern about inflation and renewed measured inflation, which in Honolulu's case was down about 2.5% at the end of last year. As of March, it jumped. This red bar here is the March 2024 Urban Hawaii Consumer Price Index inflation measure, 4.8%. And you can see that the two top components pulling it up were reportedly housing costs. Now, there's
Yeah.
some debate
You
about
and I talked about this. Yeah.
really.
No one
And
who owns a home, their mortgage payment didn't change last month to this month. But I mean, but these are the figures that are being used. And so
yes,
this
and
is the
so something
environment
out
that
there
we're
that's
in.
it's in people's minds now, and so the idea of rate cuts beginning this summer is starting to drift further
Really
out
does not look
into
good,
later this
right?
year.
Okay, let's well, we're talking about mortgage interest rates. That's what we're really interested in. So let's bring in Anders Hostelley,
How you
Senior
doing, guys?
VP at Guaranteed Rate. Good to see you again, Anders.
Nice seeing you.
Thanks
Thanks
for
for having me.
sending all the data throughout the week. Um, could you send some good news for a change
I know.
on the mortgage
Yeah.
interest rates? So, Anders, I'm pulling up right now. This is
Right.
the Freddie Mac chart, and interest rates spiked over 7%. We're not too happy about that.
Yeah.
Are you seeing that? Is this a real rate? Is this what you're doing? What you're seeing from your side?
Yeah, it's a real rate. I know you like we go back and forth during the week, and you say, "Hey, Noah," and I said, "Boy, it's getting close to 7%." Well, yeah, it hit. I mean, I pulled up interest rates and looked at it. Of course, I always say it depends on down payment, credit score, and so forth. But yeah, that average rate now it's on an owner occupant 30-year fix. It's right around 7%. So this is
Geez.
accurate. Yeah.
Been a wild ride. You go back to October of last year, we're at 8%, bounced
Yeah.
down to 6. We thought maybe we'd break into the 5s, and now we're back up
Yeah.
over 7.
Yeah,
So,
it was looking good. It was feeling good in the low 6s, and there was a lot of optimism, like you just
right.
talked about, where the Fed was going to potentially lower rates, and then mortgage rates would start drifting back down. But yeah, not the
Yeah.
case.
And so right now today, when you're looking at, and again, just sort of this vanilla 30-year that we're talking about,
Mhm.
is it still right around 7?
Yes, it is. Yeah,
Ah, that's
it's
not what
yeah.
I wanted to hear, and that is the
I
wrong
know. I
answer.
looked at it
Yeah.
today, right? I looked at it
Yeah,
half an hour
no.
before I got on here. Yeah.
Okay, I've got up on
Yeah.
the screen right now, going back to the 70s,
Hmm.
the Freddie Mac interest rate, mortgage interest rate, 30-year.
Hmm.
You've been in the business for over 30 years.
Hmm.
What to you is a normalized rate? 3% is not a normalized rate. What is something that is sort of in the zone of normal, whatever that means?
I would say probably, I mean, this is my optimistic side. I would say the high 4s, but I think the realistic side, it's probably the low to mid 5s,
Yeah.
on a mortgage rate, and
Hi, I'm Patrick O'Neill with Luxury Homes International. Don't miss next week's webinar with economist Paul Brewbaker. Be sure to hit the subscribe button below and give us a thumbs up. Thank you.
I think I know we hear a lot about, well, if rates come down into the mid to low 5s, it'll really help with the housing market. Yeah,
Yes.
I think it will. Yeah, I think it
Yeah.
would.
Yeah, that makes sense. And it almost felt like the market sentiment had shifted when we were back down around 6. I mean, I certainly through our
Exactly.
office, we
Yep.
started to see more deals. I think, it's going to be the new no, quote normal, whatever that means, kind of going forward. And then, Anders, what about adjustable rate mortgages? Is there any, I mean,
Yeah,
is it still close?
yeah, they're close. I mean, it depends on which lender, and we can send loans to different lenders. Even we have our internal arms, which don't look very good. I mean, they almost look the same, or could even sometimes be higher than a 30-year fixed rate. Interestingly enough,
Hmm.
but when you look at the banks, they're typically about 0.5% lower, maybe than fixed rate mortgages.
I
If you were
see.
looking at a 5-year or 7-year arm.
I see. Okay. And then what about the jumbo market? Still kind of tracking close, a little over.
Jumbo market's interesting. So the jumbo interest rates, you have a really good credit score. You're looking at a loan above, 1.149. You can get a rate that's in the high sixes. I mean, it could be even a little bit less than that 7%, right?
I
So there's
gotcha.
demand from hedge funds, institutional lenders for jumbo.
Okay.
Yeah.
And Anders, we're going to look more at the housing statistics, but there seems to be something happening in the condo market right now. And I think part of
Yeah.
this has to do
Yeah.
with the insurance. Could you touch briefly on what's happening out there, this underinsured problem with the AOAOs, with the associations, and also with the deductible?
Yeah, so what we're seeing is, insurance premiums have just been going up and up. There's been, events, the Maui wildfires that have, impacted insurance companies, and some have even gotten out or are being more restrictive on what they'll actually, insure, or they'll insure less, but at a higher premium, because they see their risk is higher. And that is affecting condo associations when they're renewing their insurance policies. So I've seen somewhere it's like, wow, the insurance, quote is now double, or in order to not double it, maybe the deductible is higher. That is, and that would be a longer discussion, but there's some deductibles now we're seeing that don't meet the Fannie Mae, Freddie Mac guidelines of 5%. So then all of a sudden this building becomes ineligible for conventional financing. Now there are certain lenders, what we call non-QM, that are okay with higher deductibles. And why are they okay with it, or why are they attuned to that? Because we're seeing this across the country.
I
The same
see.
thing happening where, maybe an insurance company says, look, I'll still insure, but the deductible's got to be higher. And again, unfortunately, that makes the condo project ineligible for the standard
Right. And we see
financing.
that now, and it
Yeah.
affects
Yep.
values when you can't get the conventional financing. And
Exactly.
and you're not an insurance specialist, but
Mhm.
what do you look for when the association documents come out? Is there something that you look for in particular on the insurance summary?
Yeah, we look for the deductibles. We want to make sure we have to make sure that the building has 100% replacement coverage for hurricane and everything. But the deductibles has become now, like, we just had some condo in Maui where we were all ready to close the loan, and then we got the certificate of insurance, and it said the hurricane deductible is 10%. It's ineligible for that Freddie Mac loan we were about to close. So
Because the
we did
max on
find
that is it 5%?
5%. That's correct. Yes.
Mm-hmm. I see.
But
Yeah.
yeah,
Yeah, it's an
we were
issue.
able to find a local, like, credit union that was able to, they said they would do it on an exception basis, but they looked at, the overall profile of the borrower.
Yes.
And the rate wasn't quite as good as the rate that we had been
I
offering the borrower.
gotcha. Okay,
Mhm.
that makes sense. And then I know that you track loan originations, rate locks as kind of a
Mhm.
temperature of what's coming up as
Yeah.
far as sales.
Yeah.
Have you noticed anything in the last month or so? Any changes?
Yeah, definitely the applications were up. We've seen that as a company. I think it is an industry. But I would say, boy, in the last, I don't know, maybe 3-4 weeks, it seems it's slowed down. It's slowed down
Yeah.
a bit.
Yeah,
Yeah.
interesting. Okay,
Yeah.
now our predictions on mortgage interest rates have been terrible over
You're
the
really good
last
on
two
those. Yeah.
years.
Yeah.
So I'll ask you maybe an easier one.
Yeah. Yeah. Yeah.
In 2024, the whole year
Uh-huh.
coming up, do you think there's any chance of a Fed funds rate hike?
A cut. Yeah. A hike? Oh, a
A
hike?
hike.
No, I don't think so. Personally, I
Okay.
don't think so. I
How
don't
about a
think so.
cut?
I think there may be a cut, but it won't be until November, December. Yeah.
Yeah. Yeah, that's
Yeah.
kind of what it feels like. All
Yeah.
right. Well, Anders, really appreciate you coming on. And by the way, for people who are out there looking to purchase a property, if you are getting stuck on this insurance issue, Anders is a great resource. And Anders, I always appreciate you picking up the phone for
Appreciate
us.
it.
So thanks so
Yeah, of
much.
course.
All
Thank
right.
you.
Yep. Well,
Thanks.
you
Thanks,
take
guys.
care. We'll see you shortly. Okay, Paul, and let's jump back into the real estate statistics. Great to have Anders on here, right? I mean, the
Oh, it's
information.
great.
Yeah,
Known the guy for 30 plus years as a mortgage lender, and like a lot of people in financial services in Hawaii, we're both Bank of Hawaii refugees, so
that's right. That's right.
got
Where
good
you were the
training,
former
got
chief
good training,
economist. I go, I
good
okay.
foundation.
Let's jump over and we're going to go back into the statistics from the Honolulu Board of Realtors, and we're going to start with closed sales. And it's kind of interesting what we're going to see here. So we're starting with homes. This is year to date closed sales. We can see that's up 6% compared to last year, down 33% compared to 2022. And that, of course, was the big year, right? A lot of volume.
Yeah.
Now,
Yeah.
compared to 2019, this is pre-pandemic. The reason I thought this was interesting, closed sales are only down 20% because it's not the world is falling apart. I mean, it's down, it's a number, but it's not half, or 50%.
But 20% is not a small number. I mean, you're basically talking about down 33% from when we had 3% mortgage rates, and down 20% from when we had, let's say, 4% mortgage rates. So
Mm,
this thing with the mortgage rate at 7% is really a problem.
It really is. Now, if we go over to condos, we can see closed sales are down 7% compared to last year, down 43% compared to
Mm,
2022, and down only 13% from 2019. This was a surprise to
yeah.
me. Just a little over 10% in volume. Uh,
It
any
makes sense
comments on
though
that?
that, yeah, condos are a more affordable segment, and when you get into that 3% mortgage rate window in 2022, there's just a lot of people that are able to move into a more affordable product. It's a window of opportunity, I guess, for a lot of people
Right.
that
Okay.
slams shut.
Yeah. Again, this I think is really the interesting thing for me as I looked at. This is the number of homes that are for sale in the last month of data from the Honolulu Board of Realtors. So
Mm,
there are 581 homes for sale compared to last month. It's down 3%, and not a big deal. Compared to March, it's up 7.4, and this is where it starts to get
mm,
interesting. Compared
yeah.
to March of 2022, there are over 60% more homes on the market right now. So the actual numbers in 2022, if you're home shopping, there were 360 homes for sale. Today, there's 541. Yes, there's a lack of inventory, but it's certainly a lot better than 2022. And then this is where you see the lack of inventory, down 61% compared to
Yeah. Yeah.
pre-pandemic.
Yeah,
Let me
you'll
just,
remember there. Yeah, go ahead. Go ahead. Yeah.
yeah, throw up the condo numbers and then get your take on all this. So
Hmm.
condo
Hmm.
numbers, we can see up slightly from last month, up 30% from last year, from 2023. That's substantial.
Hmm.
This is the condo market. Up 62%, tracking like the
Yeah.
homes did in
Yeah.
2022, and down 36%. The condo market, again, just seems to be getting hit a little bit harder. What's your take on this?
Well, and I think especially comparing to 1 year ago, that's just it's a car wreck, right? It's a pileup of cars, a pileup of condos, and a pileup of single-family homes, coming from the fact that once interest rates get into that 6-7% zone, it really takes the momentum out of these transactions volumes, right? It dissipates the velocity, so to speak. The other thing that a lot of people have been talking about recently is when you think about how many people were able to bust a move, in that 3% home rate environment, and how many people were able to refi in that low rate environment of 3%. There's just not a lot of people who are have an appetite to go from a 3% mortgage to a 7% mortgage. They're kind of trapped in their houses. And we may see, even as the interest rate environment improves, which I expect it will, just not as soon or as fast as we were hopeful it might earlier this year, we may see this uh inertia, right? That people kind of stuck, um
For sure. For sure.
persists for another
Yeah.
year or two.
Right. Why someone, even if the rates get to 5.5, why you're going to go from 3 to 5.5 doesn't make any sense. Yeah. I mean, there's reasons why people have to move, but yeah, you're absolutely right.
Sure.
And then let me pull this up. We used to look at this quite often.
Hmm.
We haven't looked at it for
Yeah.
a while. Months of remaining inventory. Now, months of remaining inventory is taking active inventory, dividing by the absorption rate, how many sales there are. And we've talked in general terms, equilibrium, market equilibrium, meaning not a seller's market, not a buyer's market, maybe around 4.5, 5 months of remaining inventory, something like that. Okay, would you agree? Just as
Yes,
a
I
benchmark?
think you have to remember, go thinking in my mind back to the slide of mortgage rates, all through the 20 teens, mortgage rates were below the 5% number that Anders alluded to as maybe right in the middle of the zone of where normal could be in the future. And so as a consequence of relatively low rates in the 20 teens, let's call it a 4, punctuated occasionally by a 3% mortgage rate, the market was relatively tight and months of inventory remaining relatively low. It's 2% instead of 4%, 2 months instead of 4 months.
Yep. So these are the figures, and it kind of plays out sort of interesting. So if we go back to pre-pandemic, 3.4, 3.6, emblematic of a seller's market, if we use kind of our benchmark, but it was starting to trail off, as you remember. That was
Yep.
sort of the end
Yep.
of that great financial expansion.
Yeah.
Then we get to 2022,
Wow.
1.5 months, right? Clearly a seller's market, as any buyer who tried to buy something in 2022 knows. When
Chasing.
we
Yeah.
Right. We get to 2023, we can see those figures are doubled. Still a seller's market due to the lack of inventory. And then this is interesting. So now here we are, 2024, again, a little bit of separation. Condos, 4 months of remaining. I haven't seen this for a long time.
Yeah, and as you suggested earlier, there may be an impairment because of the turbulence in insurance that is, constraining prospective buyers' choices. But yeah, two months is about the amount of time it takes to get from going into a contract and having the title company clear all the, clear all the paperwork. So we were for not just a couple years recently, but for much of the last decade in a really, really taut, if not tight, housing market situation where as soon as you listed, you were getting multiple offers and the product was flying off the shelf, so to speak.
That's right.
Except, of
That's right.
course, we're not building enough homes to put on the shelf for sale, and that's the other side of the equation that continues to be problematic in the 2020s.
That is definitely a big issue. Do you have just a moment maybe to talk
Sure.
about that
Yeah.
for a second?
Home building? Oh, hell yeah.
You share, and I know you've testified, you've shared information before about how lacking we are in the number of housing units that we're adding to Oahu. Can you give us some idea of the scope and the scale of that?
Sure. Well, let me just show you the most recent data I analyzed. The Mary Blewett over at the State of Hawaii DBED. She's great. Mary Blewett. Remember that name. She's I don't know if she's ever going to retire, but she compiles all the building permit data from the counties. And when I can combine her data, DBED's data, with these are enumerations of housing units, right? If I can combine the state's data back to the 1990s and then the Bank of Hawaii data that was compiled there beginning in the 1960s, you really see, two features that are, or three features that are striking. The blue series in the upper left of your screen are the actual data on the numbers of housing units authorized by building permit by the city and county of Honolulu through fourth quarter of last year. We don't have the first quarter data for this year yet. And right off the top, you can see the downward trend. It turns out you can extract, as I have done in the other three quadrants of this visualization, you can extract the cycle in addition to the downward trend that's apparent just looking at it, which leaves a residual amount of noise that averages out to zero. So the cycle and the trend, these are long wave, long frequency cycles. They're not the business cycle. They're really underlying housing investment cycles. And you can see that we reached in the late 20 teens and early 2020s the end of maybe the fourth wave of home building. each of which more recently has been smaller than the ones that occurred in the 1980s or in the 1960s and 70s. And in fact, 50 years ago on Oahu, you can see the numbers here on a quarterly basis around 3 or 4,000 units per quarter. The city and county was authorizing 14,000 housing units per year in 1973 and 1974. And today, it probably isn't 2,500 per year. So
Wow.
just the sheer volumes have come down. And in the neighbor islands, by the way, don't want to ignore them because we so often do on Oahu. You see a very similar pattern with these cycles now diminishing and the trend definitely turning downward. The real challenge that I see is that when the cycle is looking like it could be negative for the rest of the 2020s, when the trend doesn't look like it's turning up, and I have no reason to believe it would turn up if you listen upward, if you listen to state and county officials talk about this. I mean, they talk about building housing, but I just showed you what's being built, and
Right.
it's less today than ever recorded in my data
And
set.
if you look at the population growth during that period of time, not specifically for Hawaii, but the planet,
Yes.
we're having out migration now for other
Yeah.
reasons, but
Yeah.
yeah, just simple supply and demand. This is what forces the prices of homes up so much in the state of Hawaii.
So you have to be careful about that. The prices of homes in Hawaii are higher than they are in Oklahoma. No offense to Oklahoma, because Hawaii's nicer. Like, given the choice at the same price, those the Okies would be moving here. The Okies literally moved to California in the mid 20th century when economic challenges and the Great Depression and whatnot occurred. But you know, I don't know a better way to say this than, like, the cool markets are always going to be more expensive than the not as cool markets. And I'm sure that was true 100 years ago. I know it was true 50 years ago because I was alive. And it's still true today. But the problem with the restrictions imposed by geography, steep slopes, and water bodies, that's a problem in Hawaii that Oklahoma does not face, and the problem of regulatory scarcity, which we made up and they don't face as much of in Oklahoma. The problem of regulatory scarcity is that it makes it makes the valuation cycles very
Right,
volatile. It
right.
means that when prices go up, they explode and people are just shut out of the market.
And
Whereas
the
in a market
NIMBYism,
like
which is affecting the whole
and
country, but certainly
and the
we
NIMBYism,
excel in that here in Hawaii.
we are master NIMBYs. We learned from California, and that's the reason why the regulatory scarcity is is so extreme, and why the production volumes are so
Yeah,
low.
yeah. Well, Paul, thank you for that, and thank you for your time today. It's always filled with insights. I wish we had more time, but really
Thank you
do
for not
appreciate it.
Thank you for not putting me on the spot with my interest rate forecast, because I know it
I'm
would
not
run
going
on
to
time.
ask you that ever again. No, but it's been great. And if you're watching this and you've enjoyed this presentation, please hit the thumbs up down below and be sure to subscribe so you don't miss next month's Hawaii Housing Report. So until then, everyone, be well, be kind, and aloha.